Are you tired of getting stopped out of your position right before the market goes in your favor? Some people call it manipulation or liquidity grab. And if you want to stop being a fuel of other people's success, I can tell you that there is a way. It is called the Wyckoff Method. I promise you that if you watch this tutorial until the end, you will never view the chart the same way ever again. In this video, we will talk about the basic concepts of Wyckoff, how to use them and find them on the chart. The topic seems complicated, but in fact, everything is easier than it may seem to you at first glance. I will provide you with the key information that will give you the opportunity to effectively and successfully trade using Wyckoff methods. According to Wyckoff, classic support and resistance lines, the trend lines, do not work in the market, because the market works a bit more complicated. Most likely you have noticed that the market often kicks out your stop and starts moving in the direction you want. This happens because large institutions do not trade using these tools. No one sits in the bank and thinks to buy on the touch of the support price according to classic technical analysis. A big player is always looking for liquidity to fill his huge orders, and liquidity is the stops of regular traders. You must learn to understand how big players execute their trades. Then you will have a better chance of trading in the right direction. And I would not call it manipulation because it is the norm. This is how the market works. This stereotype came about because many people thought, or still think, that the big players are sitting around and purposely preventing them from making money by manipulating the market back and forth. And before you start, I recommend subscribing to my Telegram channel. This is my blog about trading where I share my analysis, news and thoughts on the market. Now let's talk about big money and understand how it moves. The main thing you need to understand is that it leaves traces on the chart when 100 million orders are executed. And people who trade according to smart money concept and Wyckoff can see these traces and trade based on them. I'll give you a simple example to help you understand what I mean when I talk about traces. Imagine that you own a large company and you have a lot of shares that you want to sell. Since you control a huge amount of shares, you can't just sell them all at once in a short period of time, simply because that would likely to cause the price of those shares to dramatically drop. So instead of just selling, you need to think of a systematic way to do it, so that the price moves sideways, and when all your shares are sold and allocated, then allow the market to make the right move. And it also works the other way for buying. You should buy lower little by little, sell higher to keep the market in such a sideways direction. In this way, the price will not change much. You accumulate or allocate to then allow a big price move and make profit. Wyckoff traders view consolidation in a completely different way than the average trader who trades regular technical analysis. Strategies of such traders are different, but for example, the price rises and the sideways movement starts. If the price goes up, he will buy. If it goes down, he will sell. The logic is simple. Or the trader can reason that the exit from the sideways movement will be in the direction of the previous trend and will simply open position based on that. There are a lot of similar strategies. I am not saying that they are all wrong. Sometimes you will get lucky, but this is not a complete view of the market. The point is that if trend has already started, the main positions are already open. And when the price goes sideways, you have two options for the development of the market. The price reaccumulates or distributes. And here you need to learn how to properly analyze the price behavior to determine further movement. And at this stage, you will be using the Wyckoff method, which has been proven its profitability for over 100 years. It was originally used for trading stocks, but now it is applicable for all markets. If you want to learn how to see where the big players accumulate or allocate assets, you first need to study the basic patterns and understand their logic behind them. Let's start with the accumulation pattern. In short, it is the accumulation of an asset for the purpose of further margin. On the screen you see accumulation pattern number 1. To identify this pattern on a real chart, you need to pay attention to the manipulation of lows and break of the bearish structure. This happens because the big player collects the stops of traders with open long positions to build up their huge position. You need to pay attention only to the key lows, and that is sell climax and secondary test in phase B. Many traders use these lows as support levels and open trades from there. Therefore, when such lows are updated, liquidity is released to fill large institutional traders' buy orders. That is why the price updates the lows and only then the growth starts. There is also a second accumulation pattern, which is different in that there is no spring. The price updates the low from the sell climax, and this will be secondary test in phase B, and the market start to develop upward. I rarely trade this pattern. I find it easier to use other tools to make a decision in such situations. Now, let's see how it looks on the chart. Two examples of accumulation are marked with a green square. Let's start with the first example with spring. If we want to arrange labeling in accordance with the first pattern, we start by looking for the sell climax, where the price stopped and started moving upward. Mark this low as SC. This will be lower boundary of our range. Then comes the automatic rally. This is the movement after the sell climax in the upward direction, which forms the upper boundary of accumulation. And then we look at the key elements, the manipulation with lows. The price updates the low, which is considered a support zone by ill-informed traders, thus forming ST in phase B, comes back into the range, forming liquidity on both sides, and before starting the asset pump, there is a final collection of stop losses, spring. And when all liquidity is collected and aggressive growth begins. And remember an important point, the validity of the pattern is always confirmed by the break of the structure, and only when you see that the price has updated the previous lower high, then it is already a confirmed accumulation pattern, and with high probability the asset rise will start. Now, a little bit about volume analysis in these patterns. Everything is very simple. You must remember that when liquidity is released, it is preferable to have lower volume but increased volume when the structure is broken. Let's move to the second pattern without spring. A sideways channel was formed on a chart after the downright impulse. Here will be the sell climax, here automatic rally, further upthrust and secondary test in phase B, the movement that collects liquidity of sell climax. As you can see in this example, there is no spring and there is nothing surprising in it. This is normal. It may indicate that the major player has already gained his position, or there are no sellers left and there is no need to make another downward movement. Then we had confirmation, a break of the structure, a return to the test and an active growth. I realize that it may look difficult now, but don't worry, it is temporary. All traders who want to trade using the Wyckoff method go through this. Just look at the key levels and practice. You will get the hang of it over time. Trust the process. And another important point, we use the Wyckoff method to determine the future direction of price, but you will be looking for an entry point using other concepts. There are also a few more interesting accumulation patterns that we will look at, but first you need to understand what re-accumulation is. It is the re-accumulation of an asset for the purpose of further profit. The re-accumulation pattern is similar to distribution and many traders cannot correctly determine the difference. As a consequence, short positions are opened, the market goes against them, and the trader again thinks that they are being manipulated. To prevent this from happening to you, all you need is to stop trading on pictures. Understand the logic, and all problems will be solved. Here, the price behavior will be similar to the accumulation. We pay attention to the manipulation of the lows and the break of the structure. The highs are often not updated during the reaccumulation. Regarding the labeling, here we mark a preliminary supply, a buy climax, and a shakeout. This is the move that forms the lower boundary of the accumulation and collects local liquidity. Next comes the automatic rally, which can reach the buying climax and even go slightly above this high. And often traders start to mistake reaccumulation with distribution because of this. This should be followed by spring, the final liquidity release before the pump and break of structure. Try to be patient when you trade this concept. You don't need to open trades every minute. Try to find situations on the chart that will make sense to you and you will reasonably open your positions. And now let's go to the examples on the chart. This is a buy climax. Here is a shakeout followed by a price reaction, and there was a liquidity release above. This will be the upthrust. In some cases, it may not be there. Next, we see the manipulation of the lows. Here, price updates this low by a few pips. This could potentially be a spring, but you have to realize that traders' stops are not just right over the lows or highs. So you have to look at more significant moves that are clearly beyond the key levels. Price returned to the middle of the accumulation, and there was a final liquidity release, spring. Then we have the last support zone and acceleration of the price. You can see the outcome for yourself. So what do we have here? Accumulation where there was a re-accumulation after a spring. A good combination to open a long position. Now, let's look at another example. Here, the situation is completely similar to the first accumulation pattern. The only difference is that this sideways movement starts to form after the upward impulse. The key events have already been noted. You need to pay attention that the price manipulates the low, and after the spring begins an aggressive growth. The break of the structure as a confirmation of your analysis and the movement even higher. The accumulation and the reaccumulation have been dealt with. This is the basics you need to know in order to start learning how to trade according to Wyckoff. Let's move on to distribution. Distribution is an inverted accumulation. The logic is exactly the same. The market consolidates. There is a manipulation of highs, thus collecting the stops of early short traders. And then the market moves downward after liquidity is released. The confirmation will be the break of the bullish structure. Let's look at an example. Here is a preliminary supply. Here is a buy climax. Here is an automatic reaction, a secondary test followed by a sign of weakness and the manipulation of highs. This is an upthrust. And this is upthrust after distribution. Now try to look at this situation not from the picture, but understand why this is happening. In this sideways range, traders start shorting for various reasons. Hence, above these highs, there are a large number of stops. A major player is always interested in selling at the highest price. So there is manipulation of the highs in order to collect this liquidity. And then, after the bulk of stops are activated, the market starts to really go down. And just like with accumulation, the confirmation of distribution will be the break of the structure. Only then we can expect that the price will really move lower and lower. Once again, we do not use Wyckoff to enter a trade. We use this concept to determine the future price movement. In order to effectively and correctly enter a trade, you can watch my video where I tell you how to enter a trade correctly. So you can apply the information from these two videos together. If you look at the higher time frames now, you can see a massive move down after the distribution we just defined. There is also a distribution without UTAD. I will not show this as it works similarly to the second accumulation pattern but in a reversed way. So let's move on to red distribution. A sideways movement that comes from a bearish trend followed by a continuation of the downtrend. Again, this is the opposite of reaccumulation, but here there will be a manipulation of the highs. Many traders also have a big problem with this pattern simply because they mistake redistribution for accumulation. You will initially have an indistinguishable situation on the chart. You will find preliminary supply, a sell climax, an automatic rally, a secondary test, which in this example comes out slightly below the sell climax, and you will wait for spring, after which it will start to move higher. But as I said before, to distinguish between these patterns, you have to look at where liquidity is being released, above or below, to give you additional confirmation of what you're looking at, redistribution or accumulation. And then wait for confirmation in the form of break of structure. And after that, you can start looking for a position entry. Similar to the reaccumulation but inverted, we can see how price manipulated the highs here. Here was the UT and here was the UTAD, followed by a downward movement that broke the bullish structure. Then the last resistance point was formed and the move lower continued. To trade successfully on this concept, you should be patient. Do not rush to open trades all the time. Let the market develop and enter only after confirmation. That is a break of structure. If you try to catch the maximum, you will most likely be often knocked out by stops. A bonus tip: if you have a situation where you can easily identify accumulation but cannot identify distribution, then use the chart settings. Just invert it and now you will look for the accumulation pattern if it is more convenient for you. Let's summarize. We do not trade based on Wyckoff, we only determine the further price movement. To enter a position, you need to use other concepts to open right trades with a high risk-reward ratio. This works on all time frames and in all markets. You can look for accumulation and distribution patterns on weekly time frames as well as on a second time frames. Use the market structure with Wyckoff patterns for more accurate and efficient analysis. Don't trade on picture. Instead, try to understand the logic of price movement. Practice. Try to go back a year ago, look for the patterns I showed in this video and learn to identify them. Pay attention to the manipulation of highs and lows. Also wait for confirmation. It will be the breakout structure. As you devote more time to this concept, your results will grow. After hundreds of hours of backtesting, Wyckoff patterns will become clear and easy to identify. Wherever you open a chart, you will see these patterns just about everywhere. But if this method seems too complicated for you, in the next video I will explain an easier method to trade in the trading range. And maybe subscribe, you know?